Over the decades, financial minds like Warren Buffett, Peter Lynch, and Benjamin Graham have tested and documented specific, repeatable rules for building wealth. By combining their insights, we can construct a single, comprehensive system for portfolio management. Look at the floor of the New York Stock Exchange. It is loud, chaotic, and driven by fear and greed. When individuals trade based on emotion, reacting to the daily noise of this room, they are gambling against professionals. A calculated system replaces that reaction with discipline. Executing this system requires almost nothing in the way of advanced degrees. You need an active brokerage account, an 8th grade math and reading level, and a logbook for your decisions. This diagram maps out the 3-tier portfolio we are going to build. It starts with a passive index base, builds upward with an active stock strategy, and caps off with a defensive hedge. By the end of this tutorial, you will know how to construct this exact structure to weather market crashes while capturing long-term growth. Step 1 takes us into the broader macroeconomic environment to establish your baseline asset allocation. Before purchasing a single stock, you have to define what institutions call your policy normal. This means defining your financial goals, setting a strict timeline, and determining your exact risk tolerance. This chart divides your wealth into a 70-30 split between equities and bonds using low-cost index funds. Once set, you automate monthly deposits. The system purchases funds on schedule, removing human emotion. The vast majority of beginners who attempt to time the market or actively trade lose to the benchmark indices over a 10-year period. Tracking the broader market guarantees you will capture the average historical return. Securing that average return ensures your financial survival. With your baseline protected, you now have the stability required to take calculated risks in Step 2. Step 2 builds the intermediate engine. Here, we allocate a smaller portion of your capital to a focused portfolio of 5 to 10 individual companies. To select these companies, we start with Peter Lynch's 2-minute test. If you cannot explain the company's corporate strategy in simple terms that a child could understand, you cross it off the list. Next, we look at the product itself. A company needs a strategy that creates stickiness. When customers are locked into a product ecosystem and return repeatedly, the business generates predictable revenue. In the late 90s, companies achieved billion-dollar valuations based on marketing jargon and zero actual revenue. Eventually, the math caught up and those valuations collapsed. Press releases and executive interviews are designed to sell a narrative. To verify the health of a business, you have to bypass the public relations department entirely and read the company's SEC 10K filing. Search the 10K for cash flow from operations. Then compare this cash figure to the marketing spend to reveal the exact cost of acquiring customers. Forcing a company to prove its cash flow against its marketing budget strips away the narrative. It confirms you are buying a stake in a functioning business rather than a heavily marketed concept. Step 3 adds the advanced shield. Even a portfolio of excellent companies needs a layer of risk management to protect against systemic shocks. One reliable signal of internal corporate health comes from the vital few. This refers to the corporate officers and directors inside the company. When you track these insiders using their own money to buy shares on the open market, it indicates confidence in the company's actual data. To manage downside risk, you write a mechanical stop-loss rule into your logbook. If a stock drops by a predetermined percentage, you sell the position immediately to stop the bleed. This chart shows a 3-to-1 risk-reward ratio. Before entering a trade, you calculate your potential loss against your target profit. The green profit zone must be at least 3 times larger than the red loss zone. Institutions also purchase put options on an index. If the market drops, the put option's value rises, acting as insurance. Together with stop-loss rules, this armor ensures a sudden crash cannot wipe out your wealth. You now have the complete architecture. It relies on a passive index base for survival, a strictly verified selection of individual businesses for growth, and a mechanical defensive shield for protection. The investors who designed these methods did not treat the stock market as a place to gamble. They treated portfolio management as a precise, calculated business operation based on accounting and probability. Now it is time to execute. Open your logbook, select one company whose product you understand, download its 10K filing from the SEC database, and run the cash flow analysis. By following these rules, you stop reacting to daily financial noise. You are now actively building your wealth using the exact blueprint developed by the world's most successful investors.